let us have understanding on the very important key adjustment, key changes which are proposed in recent budget 2021. The budget was announced on 1st February 2021 and it was being referred as never before circumstances budget. Why never before? Because we understand that the COVID-19 has a huge impact on the businesses. The government has spent crores of rupees for the purpose of this pandemic. Now, it was expected before budget that because of the huge expenditures spent out by the government, the fiscal deficit is very high, and there may be a few kind of cess like COVID cess that can be levied on the taxation of personal and corporate. However, good news, there is no COVID cess, there is no additional tax burden as far as the companies and individuals are concerned. The fiscal deficit for the year 2020-21 has been pegged at 9.5%. And when you look at the budget, both personal and corporate income tax is expected to rise by 22%, and even GST collection is going to be rise by 22%. Now, this is primarily with respect to the widening the base of the taxpayers. So instead of focusing on collecting higher tax from the person who are tax savvy, the focus of the government has been primarily to increase the number of taxpayers, and then it will help to get more revenue for the government. Now, let us look at basically the very important announcement as far as income tax is concerned. Before that particular point, I just take one thing. Don't tell me what you value. Show me your budget and I will tell you what you value. So budget is nothing but it just provides you the how the government is thinking, how and which are the things which have been valued more. So the activities, the projects for which the amount has been allocated on higher sides, that is the main thing where it values more. When we look at the direct tax and GST both issues, the primary objective of government is to ensure that somebody who makes issues or they try to evade the tax, they need to be penalized more than the person who is tax savvy, who has been paying as an honest taxpayers. So the first thing let us look at is no deduction if delay in deposit of employees contribution. I think there has been a dispute for so many years, and in case of Vinay Cements Limited, Supreme Court observed that even if the employee's contribution of PF has been delayed in deposit, there is no issue with respect to the its allowance for income tax point of view. However, there has been always a cause of concern for department and assessee about allowability of these things wherever the contribution of employee provident fund has been delayed by the employer. Now, what happens then in certain cases, the companies or employer use the fund of employees' contributions for the business, and they make delay to the particular delay to the contribution fund. This has been taken as a very critical thing by the government, and in this budget, it has been clarified that in case of delay in deposit of employees' contribution, it will not be allowed as deduction. So, for example, if there is a single 1 day delay, then 30%, if you are the 30%, 25% tax break, then that particular amount will be disallowed and there will be a huge burden. So the focus of government is to ensure that please be vigilant as far as the money of employees concerned. That is not your money. You will just cast a duty to ensure that you collect the fund and deposit on time to the particular fund. So this is one change which is very important for businesses. Second very important thing is on TDS on purchase of goods. Now that particular change is on other side of the recent TDS TCS provisions which has been brought out under section 206C1H. Last year the tax collection TCS has been introduced for the assessees having turnover of 10 crore or more, wherein it is mentioned that in case if of the sale of goods to a one party, where the amount aggregates is more than 50 lakhs rupees, then TCS is required to be done. So that the obligation was on the seller party, where TCS required to be done by that particular party. Now, under this budget, the obligation has been cast upon the buyer. So it is applicable to the buyer where having turnover in excess of rupees 10 crore. So for example, if you are having a turnover of rupees more than 10 crore rupees, then you are supposed to look at the TDS and TCS. TDS in case when you are when the purchases is more than 50 lakhs rupees, and TCS when your sale to the customer is more than 50 lakhs rupees, right? So this particular provision says that you need to do TDS where the amount of purchase of goods from a single party is aggregate during the period is exceeding rupees 50 lakh. In that case, the TDS obligation arises on either the accrual or payment, whichever earlier. So even if you pass general entry in your books of accounts of amount payable to the supplier, then if it is earlier than the advance received, in such case, what will happen that you will pay a TDS on earlier of the payment or the amount credited in the books of accounts. So that is the obligation cast upon. Now what is more important thing in the previous year? So if you're talking about the this provision is effective from 1st July 2021, and basically that provision says that in case in the previous year you are having a sales of more than 10 crore, then you would be cautious. Look at the provisions, look at the parties where your purchase is more than 50 lakhs rupees, and any amount in excess of 50 lakhs rupees, TDS need to be done at the rate of 0.1%. If permanent account number PAN is not there, in that case 5% will be levied, right? So applicable to only in case your turnover is 10 crore, more than 10 crore rupees, TDS to be done at 0.1%. PAN is not there at 5%. This is what the requirement. Now the question will come into mind that on a one transaction, TDS is applicable and TCS is applicable because buyer and seller, they both are having turnover of more than 10 crore rupees. Now in that case, whether I will do TDS or TCS or both to be done on one transaction. Now the response to that, that in the section of TCS, it has been mentioned that if the TDS is applicable, then TCS is not to be done. So the in where both buyer and seller having a more than 10 crore turnover, they are covered in the sections, and the value is more than 50 lakhs rupees. In such case, the obligation of TDS is lying on the buyer under section 194Q. So section 194Q, TDS will be leviable even when the both are covered under TCS and TDS. I hope this issue is clear. This is one of the very, very important thing which is required to be really known and understood by the staff and the businessmen, just to ensure that TDS obligations have been properly complied with. Let us look at next point on TDS TCS. Now here it says that higher TDS or TCS for non-filer of income tax return. Now, for example, if the TDS, so it says that aggregate of the same deductee is more than 50,000 rupees or more in each of the two previous years. I am making a payment. For example, professional consultancy payment, I am making you a consultant, and for continuously last 2 years, when the TDS is done, the TDS is of 50,000 rupees or more. So 10% is, for example, the TDS rate. 5 lakhs rupees or 6 lakhs rupees has been paid, and both last 2 years 10% TDS is done, 50,000 rupees is a TDS which is done in last 2 years, and the consultant is or deductee is not filing income tax returns, in such case the obligation is cast upon to deduct TDS at the higher rate. Now higher is what? A TDS at higher A of twice the rate specified in the act, or the twice the rate in force, or 5% higher of any of these three. So in the example which I have taken, where it is a 10% TDS, 20% will be applicable. In case of 184C, where it is a contractor 1% TDS, it is 2% or 5% higher, so it's 5%. So this is the way you will look at the TDS rate applicable. Now, the question will come to mind, how can I know that whether deductee has paid or deductee has filed ITR or not? Now, for that, it is proposed that the income tax department will be able to start with a utility on the portal, wherein once you input the permanent account number, then it will provide the compliance or non-compliance of income tax return filing. So again, just to summarize here, one very important thing is that it is applicable in case TDS, which is deducted, is a 50,000 rupees or more for the same deductee. Second thing, only when the deductee has not filed continuously for last 2 years, and the 50,000 rupees is also for the 2 years, then you need to have at a higher TDS rate. So this will help government to trace the persons, even though we have been done TDS of 50,000 rupees, they are not filing ITR, and then they can look at it and scrutinize further. So we need to be careful about these provisions. Again, let us look at the next bunch of the reduction in the time limits for sending intimation notice. Now, section 143.1, 143.2. 143.1 talks about a time limit for sending intimation, and 143.2 talks about a scrutiny notice. So earlier the period was earlier period, the 3 months has been reduced. So as far as sending intimation, so when you file the income tax return from CPC, you receive intimation. So that receipt of intimation should be within 12 months from the end of financial year. Now this has been reduced to 9 months. Same way, if for issue of scrutiny notice, it was within 6 months from the end of the year in which the return is furnished, that period is also reduced to 3 months. Now let us take an example. In case of income tax return for assessment year 2022-23, which has been filed within the due dates. Now, earlier it was 31st March 2024 was the last date for sending intimation. Now it has been reduced to 31st December 2023. And as far as scrutiny notice is concerned, earlier it was 30th September 2023. Now it has been reduced to 30th June 2023. Let us look at the next point, is a reduced time limit for belated or revised ITR. Now, earlier case what we talked about was the requirement with respect to department to issue notice, department to issue intimation. This has been reduced by 3 months. Same way, they also reduce the timelines for the SSC for filing belated or revised income tax returns. So earlier the case was there that you need to file belated or revised return within 12 months from the end of financial year or before the completion of assessment, which is earlier. Now this has been again curtailed by 3 months. So 3 months has been reduced for filing of belated revised ITR, and 3 months has been reduced for giving intimation or and by issue of scrutiny notices. So that is what, so the focus has been primarily to basically reduce and curtail the timelines for the purpose of the hanging the assessment or hanging procedures for a particular year. Now next very important point is on reducing time limit for reopening assessment. Now, for reopening assessment, earlier the year was like 6 years and 4 years. Now that 4 or 6 years, as per the case may be, this has been proposed to reduce to 3 years. Now here the focus was primarily that basically why to keep it hanging. Reopening should not be done for a longer period unless until there is a specific case of income escaping assessment for a higher value. For all other cases, you have to be very sure about the completion. So 3 years, once 3 years is completed of your assessments is completed, then you don't need to worry about that. So that period has been reduced to 3 years from the end of relevant assessment years. However, only in case of certain cases where the evasion evidence of value of 50 lakhs or more has been noticed or has been done, in that case it can be reopened for 10 years with the approval of the specified authority like principal CIT. So it want to make it very clear that if your assessment is of your ITR or the income which is covered is less, don't have to worry. 3 years completed, there's no need to worry about that. However, there is some kind of income escaping assessment with higher value of 50 lakhs or more, then the possibility is there that it can be reopened for 10 years. So as far as somebody who is involved into the evasion things, the time limit has been extended to 10 years, and in all other cases for genuine cases, genuine hardship, small taxpayers cases, it has been reduced to 3 years. So you don't have to worry about more than 3 years as far as your ITR which is being filed. Again, a new section has been introduced here, section 148A. It says that the procedure to be followed for issue of notice under section 148. So wherever you do issue notice for reopening assessment under section 148, it says that you have to follow the due process. You need to first issue a notice, show cause notice to the assessing. You need to get a reply, and after receipt or reply, then only if it is not appropriate, it can be issued notice under section 148. So this is what is as far as the requirement of reopening is concerned. Now when I look at the both the things together about the filing of belated revised ITR, then it is reduced to 3 months. As far as intervention is concerned, it is again reduced by 3 months. And as far as reopening assessment is concerned, one of the very important thing is that there is no need to worry about the litigation which can come in picture as far as 3 years has elapsed from the end of relevant assessment year. Now, next very important point is on tax exemption on ULIP proceeds. See, as far as we are aware that unit linked insurance plan has been one of the most important uh, tax incentive as far as the ULIP is concerned, where it's mentioned that it is a tax free irrespective of the premium limit earlier. So it was a case where it mentioned that there is no cap on the ULIP premium, and whatever amount has been there, the all amount has been tax free irrespective of the limit. Now what has been done that it has been proposed that ULIP that are taken on or after 1st February 2021, in that case the maturity proceeds of policies with annual premium of more than 2.5 lakhs will be taxable at par with the equity linked mutual fund scheme. So now no more exemption without limit. The exemptions on ULIP will be there. However, it is only for the small and certain cases only. That is where the annual premium is up to 2.5 lakhs rupees. Wherever the annual premium exceeds 2.5 lakhs rupees, then for the excess amount, it will be a taxable, and it will be taxable as far as a 10% taxation without taxation, without indexation. So that is what has been proposed here. But with the one caveat that in case if the amount is received on the demise or the death, then either the sum assured or the process of investment which is higher, then the nominee is not subject to be taxable. So except in case of the death and the receipt of the money by nominee, if the per annum annual premium exceeds 2.5 lakhs rupees, then for the excess, tax need to be paid as per the normal equity linked mutual fund schemes. So one need to be very cautious as far as the ULIP is concerned. Just look at your portfolio of ULIP, and then based on your annual premium, you need to take call whether you want to make investment higher or not. Next very important point is that as we if you look at the government's focus has been primarily to reduce the tax litigations and to ensure that the small amounts, small litigations shall not go at a very high level, and it should be reduced as far as possible. So one new thing which has been done is that is constitutions of a separate dispute panel. So separate dispute resolution panel or committee DRC will be constituted, and that constitution is only for the purpose of the small taxpayer. Now the small taxpayer has been defined as a taxpayer where having an income up to 50 lakhs and a disputed income up to rupees 10 lakhs. So in that case, it has been clarified that you don't need to look at the more litigations and every way where you go from here to tribunal and another way. You don't have to worry about all these things. Your dispute will be resolved at a smaller level, by just a committee which is separately being notified for a small taxpayer, and then it will be taken care. So that is a new change, a new committee which has been introduced for this point of view, and I'm sure that this will really help to resolve the number of issues which are unnecessarily going and staggering at the higher level. And if it can be resolved at the smaller committee, then the disputed cases at a tribunal level, at court level, will be completely drastically reduced. Next very important point is been as just to see that the fake invoice, anybody who is involved in the fake invoice, see look at the provisions to curtail the fake invoice, whether it's GST, whether it's income tax, everywhere. Somebody who has been involved into fake invoice thing, then everybody who is connected with that, they've been penalized strictly. Government has identified over the period that one of the big issue which government has faced is the loss of huge revenue due to fake invoices. So when we look at the GST, in GST also the input tax credit, there is a lot of restrictions on claiming input tax credit. Why? Because government doesn't want to pay you money if somebody has not paid to government. Same way here, again they want to say that in case of the fake invoice where the value of penalty likely to be rupees 2 crore more, provisional attachment can be done. So that is again giving a power to the officers that where it has been involved in this case, you can provisionally attach the assets of the person who are being involved here in this case. Now, one very important point which is on depreciation on goodwill. See, this has been a disputable case for so many years. In case of Smith Securities Limited, the Supreme Court said that the depreciations on a goodwill shall be provided because the value has been reduced over the period. Now, this has been always an issue for the government, and department doesn't want to really agree with the concept that somebody can claim depreciation goodwill. In certain cases, what has happened that certain companies have created goodwill by way of merger, amalgamation, reconstruction within the particular structure, and then goodwill is created. A goodwill has been written off by 25%, and then there the tax has been reduced. Now this has been manipulated in certain cases, and wherein the depreciation on goodwill was claimed, and that's why the government was receiving less tax collection. Now, just to sort it out these particular issues, what has been proposed that now, irrespective of anything, and not no goodwill will be allowed or no depreciation on goodwill will be allowed with respect to goodwill that arises on merger, acquisition, or amalgamation. So this has made the point very clear that now onwards you cannot count that goodwill which has been arising on that, it will be subject to depreciation because Earlier, it was not specifically mentioned under Income Tax Act. However, now it has been clearly mentioned under Act. There is no ambiguity left, and that's why now onwards you cannot claim depreciation of goodwill. Second thing, no one should plan in such fashion that it result into goodwill, which will be available as a deduction, because this particular benefit which is available earlier, now it that particular loopholes has been blocked, so that to ensure that no unnecessary or unjustifiable things will occur as far as a claiming of depreciation on a goodwill is concerned. However, as it is mentioned here that the cost of acquisition of acquired goodwill is to be allowed for computation of capital gain on consequent sale. So when you sell in tomorrow, the cost of acquisition will definitely include the amount of goodwill, and that goodwill or that cost of acquisition including goodwill will be allowed as a deductions for the purpose of computation of capital gain when you make a subsequent sale. However, you cannot get the depreciation on the goodwill. Now, one very important thing is amount on tax audit limit. Uh, a year back, the tax audit was that if you are having turnover of more than 1 crore rupees, then the tax audit is leviable. Last year budget, they increased the limit of tax audit to from 1 crore to rupees 5 crore with the condition. So one important very thing, it is not to all the cases. However, the government wanted to say that if you are giving importance to digital, and if your businesses and accounts are more transparent, how it's possible when your receipt and payment, they both are through digital way, then in that case, if it is your cash receipt or payment is up to or less than 5%, then in such case you are eligible, that you are not required to do tax audit for a turnover limit of 5 crore last year. Now from the current year onwards, and this is applicable from the financial year 2020-21, that if your turnover limit is up to 10 crore rupees, and if your cash receivable payment is less than 5% of total receivable payment, in that case you are not subjected to tax audit. So government wanted to give these relaxations to the small associates, provided your accounts are transparent and entering into the digital way. Non-cash business or receipt payment is one of the more important evidence which suggests that the accounts are transparent, and you are eligible to get the very important benefit of not requiring a tax audit. Now next very important point is on basically interest on loan for affordable housing. See, Section 80EE provides a deduction up to 1.5 lakhs rupees in case if you take a loan for affordable housing. Now, this particular thing basically it says that this was about to complete by 31st March 2021. This has been extended by one more year. It says that even though loan is sanctioned up to 30th March 2022, and if the loan has been taken for affordable housing project where the value is less than up to 45 lakhs rupees, and the home loan is taken up to 30th March 2022, loan is taken from bank or financial institutions, and then in that case interest on such loan up to 1.5 lakhs rupees is allowable as a deduction. Now one very important condition which I would like to add here is that the section also has a condition that you should not own any residential house property on the date of sanction of loan. So the date on which the loan is sanctioned, on that date he should not own any residential house property. If that condition is fulfilled and other condition which I mentioned has been fulfilled, then you are eligible for the interest reduction up to 1.5 lakhs rupees, and that benefit was to be expired on March 21. It is extended to by one more year of March 22. Now same way there is again a extension of one year. Now why this extension? Because I think the one year has been basically already gone. If you look at from our own life or business, in many of the cases The 10 months, how the 10 months has lapsed because of COVID-19 is no one is aware about that. That is the reason why this has been extended further. And again, the benefit, if you are startup registered, you get income tax benefit of 3 years exemptions. So that tax holiday period benefit is again has been extended up to 1 year. So even though your startup has been incorporated up to 31st March 2022, still you are eligible to get that particular benefit. Another thing, the capital gain exemption for investment in case of transfer of residential house property and investment thereof. That exemption was also being going to be out by March 21, extendable by 1 more year up to March 22. Now let us look at the few more important changes which have been proposed. Faceless ITAT. I think everything is going to face this, whether it is at appellate level or at higher level. I think except High Court, everything is now faceless. Assessment faceless, ITAT faceless, appeal faceless. So basically, this is the way the government wanted to work. So it will. The objective is to ensure that any issues or possibility of the wrongdoing need to be eliminated. Human intervention as possible should be reduced or eliminated. Who is a part of committee, influence of the committee, they all should not be given weightage. Then only the fact of the case matters. So facial ITAT is a step forward for that. Very important thing, when the finance budget was started, one of the most important first adjustment or policy change was there, that senior citizen will not be required to file ITR. However, please ensure that that is subject to the conditions. One, senior citizen above 75 years of age. Two, the senior citizen having income from pension and bank interest. Third, the both pension income and bank interest from the same bank. Fourth, the bank need to compute TDS as by going through all chapter 6 and deductions, and thereafter TDS to be done. So the duty is cast upon the bank to deduct TDS after considering all the deductions and the bank interest income and pension income. So this is what is subject to many conditions. So how far it is practicable, how it is going to happen is not sure, but yes, the focus has been to see that the senior citizens, if they fulfill these conditions, then they may not be required to file ITR. Another point which was on dividend. So earlier was that even if you receive dividend in the last quarter of the year, still it is a part of the income, and you are supposed to pay tax from the first installment of advance tax. Now the question was that how can I know that I'm going to receive dividend in the last quarter? So how can I be subject to interest for shortfall of advance tax if the dividend has been declared later on? So that particular point has been resolved and made it clear that in case the dividend has been declared later on, so your declaration of dividend to be computed as a date from which you are required to look at your advance tax installment, not before that. Settlement commission has been discontinued, and there will be another board, interim board of settlement will be done. Next point is a pre-filling of details while filing ITR. See, government has many informations, and every information, whether it's a CB, bank, demand, they all are available. So many information of yours will be pre-filled when you file your ITR. This is the way the all information is exchanged across various servers and various agencies, and that will be pre-filled. So your filing ITR will be much more easier than earlier. Next point is on the LTC leave travel concession cash scheme. So because of COVID-19, in certain cases will happen that the people have avoided travel. Now in that case, how can they get benefit of LTC? So that LTC cash allowance has been come subject to conditions. One, that the purchase of goods or services attracting GST at 12% more to be purchased. So like whatever may be your LTC, you need to purchase of goods or services, and that goods or service should have a 12% or more. Payment should be done through the banking channel, and you have to submit the invoice of the purchase of goods or services to the employees. So GST of 12% or more is required when you make this kind of payment, and then the purchase should be done between the period of 12th October 2020 to 30th March 2021. So that is what has been basically talk about the LTC cash scheme. So in case a leave travel is been not being able done, you can do by way of the purchase of goods or services where GST is at the rate 12%, and then you can claim the exemption for that. ITR for because partners, if you're a partner of the partnership firm is subject to the transfer pricing, then your due date has been proposed to 30th November instead of the normal case. Presumptive taxation. Section 44 ADA talks about the presumptive taxations. Now it has been made very much clear that this presumptive taxation shall not be applicable to limited liability partnership, because under LLP Act it already talks about maintenance of books of accounts. Therefore, the LLP has been kept out of the presumptive taxation provisions of Section 44 ADA. Now let us look at the quick overview of the GST proposals. Right, the first and very important thing is that on ITC restrictions, I think as I discussed during income tax point of view, that one of the most important issue for the government is the fake invoice. And just to curtail the fake invoices, a lot of changes are having happening, whether it's a provision attachment penalty, or in all the cases the government has been very strict as far as the GST fake invoice is concerned. Now one of the conditions has been fulfilled for the claiming of input tax credit. Now in case of input tax credit, again it says that basically it can be available only when the details of such invoice or debit note having furnished by supplier in the statement of outward supplies, and such details have been communicated. So if you want to claim input tax credit, first condition was that you should have a documents in your possession. The duty paying document like invoice, debit note are in your possession. Second very important thing is that the goods or services are received. Third important point is that the tax actually is paid to government. Again, that is again dispute by a lot of associates in court. However, the third point says tax is paid actually to the government. And fourth condition is that the return has been furnished under GSTR 3B. So these four conditions will be critical for you to claim input tax credit. Now, along with this fourth, one more condition is added. It says that you should have filed GSTR1. So GSTR1 has been filed by that particular supplier, and only when it has been filed, then only you can claim input tax credit. So that was the point. So you need to look at that from whom you are purchasing. That particular supplier has filed input GSTR1, and once it has been filed in GSTR1, it has been reflected in your GSTR2A. So this is one more condition, and because of this one more condition, we can say that you can claim input tax credit only when it is reflected in 2A. Earlier, it was said 20% variation is okay. Then they changed to 10%. Then it changed to 5%. Now it is very much clear with this that whatever is reflected into a, that is only you can claim as per this particular provisions. Next important thing is that GST reconciliation, GSTR 9C, GST audit. This has been dispensed with, and now the self certification has been added as one of the very important point. So relaxation from the GSTR 9C of like certification by the chartered accountants of cost accountant is now not required. Third point is on interest. Interest to be paid on what? Whether it is to be paid on the gross amount or net amount. This has been the issues burning issue for so many years now. Previously it was issued in last year that GST interest is to pay only on net interest basis, and now it has been done by law. So under law it has been made it clear and retrospectively from 1st July 2017 onwards, interest is to be paid only on net cash basis. So if you are to make payment of 100 rupees and basically if 30 rupees is your input tax credit, then only on 70 rupees, which is the amount of shortfall to the government, on that net amount only you to pay interest, not on gross basis. Next points are basically on seizure and confiscation of goods and conveyance in transit. There has been two sections. Now, what is done that they both sections have been dealing. Section 129 and 130. 129 was on for in transit. 130 is on confiscation of goods. They both have a dealing. Second very important thing is that they made it very clear that the transporter to pay penalty under section 129, that is what has been clear. So here what happens that even though the supplier has closed his obligations, but the case against the transporter may continue. So that is what has been made clear under next point. uh, Self-assessment and tax and recovery. This says that if the liability is declared in GSTR 1 and not declared in 3B. So I have filed GST 1 wherein I have declared that this outward supply of XYZ amount is done. However, that is not included in GST 3B. So that is not being allowed. So recovery can be initiated only on the basis of filing GSTR 1. So there will be a reconciliation of GSTR 1 and GSTR 3B. Something which is in GSTR 1 and not in 3B, this is also a point of the recovery for the government. Provisional attachment scope has been expanded to include many other things, which includes assessments, inspection of goods, search and seizures, arrest, and demand and recovery. Pre-deposit for appeal filing. So earlier there was no mention that you do deposit certain amount. Now it says that you do deposit 25% of the penalty to be deposited in case of the detention and seizure of goods and conveyance during transit. The penalty on seizure and confiscation of goods and conveyance in transit. Now, in case if the owner wishes to make payment, that penalty was earlier 100%. Now that penalty has been increased to 200%. So even though owner wants to make payment, the penalty amount is increased to 200% of the tax which is leviable on that in case of these cases. Now coming to the last particular point and is on relaxation for companies LLPs. Now this is not exactly as per as the income tax or GST provision is concerned. How it was covered as a part of the other proposals and speech, which says that the for 1% company earlier if they exceed certain limit, then they need to convert themselves to a company compulsory. Note that there is no restrictions as far as the capital or turnover is concerned. Even if your turnover exceeds the limit which is specified earlier, you can still be OPC 1% company, and you can convert to any type of the company at any time. So that was one very important thing changes which has been proposed here. The small company definitions has been increased. Now what happens that once the small company definition has been increased for turnover from 2 crore to 20 crore and paid up capital limit for 50 lakhs to 2 crore rupees. So now the all companies having turnover up to 20 crore rupees and paid up capital up to 2 crores, they are called small companies. So a lot of relaxations were there, exemptions were there for small company. They will also be applicable for the larger number of companies covered under a small company. And last point is on decriminalization of LLP. Under Companies Act 2013, there are certain procedural matters which has been taken as a criminal provision. Now this has been decriminalized last year. On the same basis, the government intends to decriminalize certain procedural lapses under LLP also. So this is also going to happen in the future. So as far as the provisions of companies or LLP is concerned, it has been more relaxed compared to earlier, and it just provides a way that yes, you can think of having your own company or LLP, and if you are a small company, you can still enjoy a lot of relaxations and exemptions which are being granted to you over this period. Now, this is what is a snapshot summary of the whole. There are many other changes which may be the part of the budget, but however, due to short of positive time, I covered the very important point which I feel are critical for businesses.